Good morning, everybody. Welcome to the Flow Show. Hope you've had a good weekend, and I hope you have a good week ahead. Morning, Kay. I'll just see you sneaking in late. How you doing, mate?
Yeah, I lost track of the time just for a minute there. Good morning, everybody. Good morning, Ryan. I hope everybody had a great weekend. Let's rock and roll.
Yeah, let's rock and roll. So this is the week after all the central bank events last week, so we get to stick our teeth into all the data that's to come this week, which we'll have a little look at shortly. Let's kick off in China and more worries around the property sector, with China's Evergrande saying it can't issue new debt and potential problems with all this restructuring that they were attempting that is hitting some roadworks and not been able to be completed. Also, there was another property firm out of Beijing, but it's been declared bankrupt in Bermuda. So, take that as you will. It's not likely to affect anything wholesale at the moment, but it's yet another problem in the property sector for risk players to get their teeth into. Something else that's popped up is that a PBOC advisor says that China has limited room for more monetary policy easing and should pursue structural reforms to revive the economy. That potentially takes away some of the easing bias of the PBOC by declaring that they have limited room, although the PBOC will probably say differently. But they have been reluctant to go hammer and tong on the policy easing thus far. Just small cuts here and there to some of their rates. Well, we did get that RRR cut as well, with potentially more prompted for the latter part of the year. So maybe we'll get a bit of a pushback from the PBOC on that advisor. Probably got the men in black suits appearing at his door sometime soon. Anyway, moving on to Japan, and Yomiuri report that they want to boost take-home pay for part-time workers. So this is firms who employ around 100 plus people. They're going to give a boost of about just over $3,000, which will just take the pressure off welfare payments, if you like, that firms make for workers. So this is to sort of subsidise that, to allow firms to give longer hours and higher pay, and offsetting that cost. This is all part of PM's Kishida's measures, which he's asked his party to consider. I think tomorrow we might get the full soup and nuts of it, but comments out of Kishida so far says that they're going to strengthen tax breaks to boost wages. He's aiming to move from a cost-cut-led economy to one with active investments, and they will compile the extra budget soon after the package is complete. So these measures potentially coming out tomorrow, although we've probably heard quite a few of them already, and this is for discussions to start within the party over these before they finally nail down numbers and what areas they want to target. On the Bank of Japan front, BOJ's Ueda said that they won't directly target FX in guiding monetary policy. When stable and sustainable achievement of the 2% inflation target is foreseen, we may end YCC. He then dropped a bit of I wouldn't call it an own goal comment, but it wasn't one that would inspire that much confidence. He says he doesn't have a clear image on how to tweak YCC, including the 10-year JGB yield target, which is a bit of a strange comment because they've obviously adjusted YCC twice. The first one, as they mentioned, was not a monetary policy move. So they have started tweaking YCC, but now they say they really don't have a good idea on how to do it going forward, which is a very bearish comment, and no surprise to see dollar yen pushing up to fresh highs on the back of all that. Uchida was out as well, saying uncertainty is high on Japan's economy, and he pushed the usual easing lines, saying it's not a situation where achievement of 2% inflation target is in sight. We've got to remember also that one of the reasons why the BOJ stayed on hold, kicked the can, was for all these Kishida measures to come out and get put into motion. No point in artificially ramping up rates that they would particularly have to borrow at by just dropping a few hawkish comments that won't come to pass for 6 months. But still on the very dovish side, aren't they, Kay?
He is. Now we always have to take it with a small pinch of salt, and the possibly lost in translation, translating from a Japanese, which always has a lot of like every affirmation could be another question. But yeah, if it's a real correct translation, it's clear. I mean, as I said in the room this morning, it's really the Bank of Japan is going to sponsor the government finances, and then they will probably normalize further. But it's really the case of like Ueda says, I'm going to sponsor you guys, and Suzuki, you take care of the yen. And it does feel, in simple terms, a little bit like that, right? Right now. And yeah, it does seem clear that he really wants to wait for all those measures to come through, see how much they are going to need in funding, and then give them the time to fund it, and probably Bank of Japan buy another jumbo amount of JGBs before we reach 1% in the tens, and that's and then afterwards normalize further, and then normalizing. What do you call normalizing? We're still officially at minus 10 BPs, right, in the short-term rates, and you can let YCC go in a way, but if you keep your rates virtually flat, imagine that they go to flat or even 0.25% positive. I mean, there will still be major players who will be able to borrow at cheap rates on a day-to-day, right? So, and we've already seen the major players in Japan not even waiting for JGB yields to reach 1%, and already stepping in. So it's all going to be a bit bizarre, and I reckon we are going to have to get fresh interventions probably at some stage, because what the Bank of Japan and the government are doing is negative yen. There's no two ways about it, right? So for the people who want to play long yen for longer than a session or two, you're going to need help from the MOF, I reckon. This and let me just add, while it's Monday, last week of the month and the quarter, we've got to be very careful, because this week could be a week where the MOF has to go to work, because if the models are correct, if my hunch is correct as well, this could be, and if you look at the yields, if you look at the equity markets, this could be a market where we see a final rush into the dollar for September. It's already kind of happening, and bringing it back to the end, that could mean that we are going to see that 150 at some stage, and then we will have to be very, very careful.
Yeah, a lot of the market put in 150 as the new 145 in intervention terms. But we've always got to remember, it's not the level, it's how it gets there. Though perhaps maybe they start to talk it up based on the level rather than the speed and stuff. It's always something we need to watch out for as well.
I reckon that they're looking at that trade-weighted index, or the closest to the near that the Bank of Japan publishes every day, and I reckon that's what those guys at the MOF and probably Kishida, because he even commented about the yen today, are looking at. It's not the thing like MOF and BOJ, they have their eyes on the dollar yen, of course, and they will have their eyes on live pricing, of course. But it's we've been saying for a long time it's the speed, not the level. But the level where we are now on the trade weighted index, we can assume with a certain degree of certainty, let's say, that they are watching this thing as well, and it's perhaps not only going to be the speed at this level.
Yeah, and for those who are not in our chat room, we do have our main man, Father Ted, keeping an eye on the sort of trade weighted index that he's got. We're keeping an eye on the Bank of Japan near measure, which are all below levels that they intervened in last year. So that's why the weight of yen overall, not just in one pair, might be the trigger for them to up intervention talk and maybe even get them pushing the button. But we shall see. We keep monitoring it. But at the moment, the volatility isn't there, and the speculation lines aren't in the jaw boning either. So if those suddenly pop in, then we're really close. Anyway, moving on, coming over to the data, and this morning we had German IFO numbers, which a little bit mixed. We had the main business expectations ticking up 2 pips, matching expectations. We had the current conditions beating expectations, but a small miss on last month. Business climate coming in, again, a beat of expectations, but a small loss on last month. So if anything, I'd say these numbers have stopped collapsing. I think that's the best way to read this report right now. Doesn't mean things are getting better. It just means for now they've stopped getting worse, which is about as good a win as Germany might want for in this day and age. ECB's De Guindos says risks to inflation are now balanced. ECB's De Kos says that underlying inflation is now easing. So we seem to have finally turned a corner. Bit of a victory lap there. It is certainly too early to talk about interest rate cuts at the moment. We certainly can't rule out cuts, but I do not want to and cannot confirm them either. That's a bit of a comment because the Guard won't want cut language coming in at all, irrespective of how the central bankers are palming it off. The fact that it's in conversation, be it questions asked by the press or whatnot, is something the ECB are going to be forced to fight. We're in it. We're in the growth trade / cut trade at the moment. The market is going to push that cut trade every opportunity it gets, and that potentially diminishes the higher for longer message that they want to keep in place. And the same will go for the Fed and the BOE and everyone else that's been hiking recently. So more and more we're getting this cut talk into comments, and I think that's something Lagarde will want to stamp down on. ECB's Lane says that 4% interest rate is expected to do quite a bit to bring inflation to 2%. They're still data dependent and need lots of data to feel assured that prices are heading towards their goal. Then he said the euro area economy is to be fairly muted this year, which is a bit of a no shit Sherlock moment, considering we've only got 3 months of the year left. It's sort of like trying to give us a prediction for a football score when it's 2 minutes into injury time. But there you go. That's the ECB for you. Coming back to some of the data from last week, just to have a bit of a refresh what went on. We're looking at the S&P PMI for the US, which was all there or thereabouts. Manufacturing came in at 50.1, which was just a pip less than last month. Services softened a touch, but by no great shakes. Both of them holding above, manufacturing. That was a manufacturing. I was looking at the composite. Manufacturing gained a bit. Services lost a bit. Held up well overall. Manufacturing still in contraction, which is not good news, but it's followed the same as we saw in the others, where there's been a bit of an improvement. We need to see whether they get back above that magic 50 line. Services just holding the line there or thereabouts. So nothing really for anyone to get their teeth into there, but it wasn't any real bad news. Canada saw some positive news. Retail sales up 0.3% on the month, but if you strip out autos and the like, they went up 1%, beating expectations of 0.5%. So decent data there for Canada. So they've got a relatively soft landing conditions. We need to keep an eye on those inflation numbers that have been up twice in the last 2 months, quite chunky as well. The BOC turning slightly more hawkish. Could there be another hike in the pipe for those guys? Back to the Fed, or the US and the Fed, and Fed Collins says that it fully supports the guidance in the dot plot. Rates are expected to stay higher for longer. Current phase of policy requires considerable patience. Fed's Daily says the FOMC stayed on hold in recognition that we are closer to our destination, holding rates to collect information to see if more is necessary. But holding rates doesn't predict what the Fed will do next, and we need to go at a slower pace. Now, Fed Bowman was quite hawkish, considerably hawkish, considering that the vote from them was for a hold. That decision was unanimous. There was no dissenters against that, but says further hikes likely appropriate with inflation still too high. Need policy at a restricted level for some time to reach 2% inflation in a timely way. The progress on inflation is likely to be slow under the current conditions, suggesting the need for even tighter policy. There's a continued risk of further increases in energy prices could reverse some progress on inflation. The economy is growing at a solid pace, with robust consumer spending and solid jobs gains, and there's no sign of a sharp contraction of credit that would significantly slow the economy, which is a bit different to what we've seen in some of the comments and conditions and surveys that have been out of late, that there is tightness in credit. But for the moment, it doesn't seem to be crimping the consumer wholesale. Lastly, the US and China apparently are going to start working groups on economic and financial issues. This was a piece dropped on Friday, various sources saying that there's going to be a bit more closer cooperation between China and the US, creating these working groups to oversee things. So it could be seen as a bit of a sign of softening tensions between the two. That brought a bit of a bid in the one on Friday, not a lot, and it's completely gone the other way, likely due to that PBOC story and the Evergrande and other property news there. Okay, got anything on your docket in terms of news?
Well, nothing really. It's a lot of opinions and people trying to figure out why gold metals are holding up. There seems to be again some Chinese Chinese in the price, still trying to buy more gold. The one thing I thought there's been two things on those. So we heard about U.S. officials talking to the Chinese a little while ago. I think it must be a week or a week and a half ago. Perhaps it's a rehash of that one, but I'm a little surprised that CNH hasn't reacted a bit more. We had this mini reaction on Friday, where the dollar CNH went down from 7.30 and a quarter, was it somewhere, to 7.29 and a half, and that was it. Of course, the dollar is beat. Now the dollar is undeniably beat. We can see it everywhere. But I would have thought it may have had a little more impact on the positive side for China than what we saw. And dollar China is already higher again, like getting really close and or trading nearly on the 2% top of the band again on the dollar CNH. So I'm quite, I mean, just wondering. So investors don't seem to have bought or don't seem to start to buy the picture again of the bit of a thaw in the relationship. So we'll have to keep an eye on that. It's probably also a bit linked to risk. We've seen, I think, what we must look at the end of the week and the start of this is those yields are pushing higher again, and the equity markets are pushing lower again. I think those are the stories to start this last week of the month and quarter that we really need to keep a close eye on as well.
Yeah, very much so.
And the last thing is just back onto the SMB. We had some comments from Jordan and I think another SMB guy since the SMB meeting. They do seem a little bit more at ease with the level of the Swiss franc, although they keep the intervention line firmly in there. But if you look at, try to read in between those lines a little bit, they do seem a little more happy with levels that they are. Also, we heard that, we saw that they expect the CPI to be just within their 0 to 2% band. And if you look at Swiss franc, and if you look at those comments, they do seem a little bit more happy with where things are right now.
Yeah, I'm still seeing Swiss pairs gaining on that, putting in quite decent moves on those. So yeah, the comments, it's a bit of a strange. I mean, they never really got the inflation pickup that everyone else has, but they all, every time you heard them, it was as if they did have that. Hence why they were hawkish. But
it's because they export their inflation more than they import it.
Yeah, exactly. But yeah, I'm leaving the Swissy to you guys. It's a bonkers currency at the moment. Probably the most manipulated currency out there. So yeah, I know you've been looking at this from the long side for a while, mate.
I mean, but
yeah. So
I mean, in Euro Swiss would have been better dollar Swiss if you look at it. But then I've been long dollars elsewhere for a bit, so that's okay. Yeah, but for the rest, really news. We haven't really heard that much news, right, over the weekend. It was a relatively quiet weekend.
Yeah, very much so. Right, let's have a look at a few pairs then. We had a brief look just quickly at dollar yen. It's doing its grind thing. Okay, this might be a bit of a reflection of the month end stuff. Kay's just been mentioning, which is probably going to be happening all week. It is quarter end as well, so there's heavier possible influences going on here. We've had a little break. This level was just a prior high from the 152s. When we pulled back from there, it became a prior high. We've got another one up at just going into the 80s up there as well. So you can see it's just grinding. I mean, it's taken all morning to go from 44 up to 59.60. So going to be expecting this. This is when it does that thing where it doesn't really pull back. You don't want to buy at the top, but you don't really get a pullback to get into. So it's one of those ones where if you're not in it, you've either got to take the risk of buying at the top, or you just got to wait for it to do its thing and get to a point where it does have a decent pullback. But for now, we're creeping up. Wouldn't be surprised if we're seeing it up towards the high 148s later on today. Got to keep an eye on yields though as well, irrespective of the month end angle. If yields remain going up as they are now, that's going to bring a secondary influence to dollar yen as well. So lots to look at. Now, I mentioned we have got some data this week. I think it's going to be important data, particularly for the US and for the rest as well, because there's a lot of consumer-related data coming out over this week. We get some house price data, new home sales, get to see if those are going to be strong, if there's going to be further problems coming into that sector. The main conference board, consumer confidence, we saw the Michigan take a little bit of a knock on the head, and inflation expectations dropping. Is this one going to follow suit? Again, it's going to maybe cement the reason why the Fed have gone on pause. depends on whether they've seen that data or not. Not often one I'd look at, but the consumer is going to be a big driver of what happens with central banks. So any consumer-related data needs looking at now. So the GfK consumer climate from Germany tomorrow. Durable goods as well, because durable goods contains things like white goods, computers, electronics. Again, very consumer-related market or sector here. So if there's problems there, it suggests that there might be a slowdown in the consumer. Then we get some CPI data kicking off, flash numbers coming from Europe. We'll get the regionals on Thursday from Germany ahead of the main number. And as you can see on Friday, further CPI data ahead of the Eurozone flash number there as well. Retail sales, again, Japan, Germany coming out. And also later in the day, we get the PCE numbers from the US, which is going to add or subtract to what we saw from the CPI data the other week from the US. So is that going to confirm what we saw from the CPI, that inflation may be starting to tick up again? We will have to wait and see. But as you can see, plenty of data to get our teeth stuck into. Right, looking around the grounds, Euro Sterling, obviously one that I've got a lot of interest in, and we're just doing a bit of a grind itself, just up around this 87 area. Into the big figure, not really ticking above it. It's had a little mooch, a couple of pips, call it spreads. But unless we really break above 87, 15, 20, call it, all these prior tests here, there's a bit of a risk that we do top out a bit up here. I'm getting a bit twitchy that I might try a little break trade if this goes, but I want to see the driver. I don't see any fundamental reasons why this should suddenly jerk up. So it's going to be maybe the flows in the dollar hitting cable, hitting euro dollar. As usual, cable may go more than euro dollar. So if that's the reason why this is pushing up, I'll be less inclined to try a break trade and add to my existing longs, or else I'll just manage what I've got and see what it does and take it from there. Just looking at some of the others, dollar CAD staying below the 135 for the moment, but staying in this zone. So the picture's a little bit muddy here at the moment, what it wants to do. Oil had that move off of the highs, which I think is putting probably a bit of a break on the CAD for now. You can see the picture's almost identical in the price action there. We got into that zone, held it, but now we're back below. So again, keep an eye on oil if you're trading dollar CAD, because if this starts pushing back up against that zone, it's going to put more pressure on dollar CAD. So there may be an opportunity if we're seeing some dollar strength purely based on month inflows, and this doesn't start collapsing. If dollar CAD starts gaining, might give us a little bit of an opportunity to maybe try a short if we get up towards those 136s again. But we'll keep an eye on that one too. Kay, you got any early feelers out this week?
Yeah, I can look at a few. Do you want to cover the sterling CAD, or well, if you want to cover it, I mean, on a technical basis. But if you look at both currencies are diverging, right? Sterling is pretty offered.
Yeah,
CAD is pretty.
I've got sterling CAD up there. No, you can have that. I was looking at Euro CAD, which is looking a bit interesting as well.
Yeah. Euro CAD is on an interesting level there as well.
Yeah, so that one's.
Yeah, I'll cover it too then. Yeah. And the first thing I'm going to do, if you give me the screen, the first one I'm going to look at is Gordon commenting on the S&P reserves. Look at what they did since the S&P told us that they were going to intervene and fight deflation through the Swiss franc, right? So this is one where that I actually jumped on to the other side and went short Euro Swiss in those days. They really intervened for a lot, right? They have sold. Well, I mean, you can actually, they have sold pretty much 100 and 150 odd, it's in Swiss franc, right? 150 billion equivalent Swiss franc over the past year, let's say. Hold on, I'm killing my stroke here. So yes, they still have a fair bit of reserves, but then if you compare it to where they were before, they are back to 2019 levels. So it ramped up during the pandemic, and now they sold everything out of it and more. So they were at a level where they built up post when they let the Swiss franc go here. They built up, but then because they were actually intervening regularly to stop the Swiss franc from strengthening, and now they are on the opposite course. So they've already it's already been reduced by quite a bit. So yeah, still a lot of reserves for sure, but back to 2018 levels. So it's less impressive than where they were. So that just for the little aside on the reserves. So and speaking about the Swiss, so last week I thought there was a case for the SNB to be more happier with the level of the Swiss franc we have seen. And if you would overlay those reserves here, this is where they started to talk about those really reserves here, and then Swiss franc really started to strengthen on the back of them just buying Swiss franc. So last week I said, okay, this may be the meeting where they start to flip around. Well, they actually surprised us by not raising and putting the inflation expectations inside the range. So I started to buy a few here. Could have done dollar Swiss as well, but as I said, I was a bit long dollars elsewhere. So and I missed actually my entry in dollar Swiss. And now we are like, I think for as long as we're above 96, 95, 90 on that Euro Swiss, it does look like we may start to push a bit higher if we get closes above 96, 65-ish. Okay, so I don't think it's going to go very fast. It's going to be one where we have to be patient if it ever goes. If of course S&B decides that they don't let it, that they won't let it go, they can put it back down again. But then I think I'm long at a pretty decent average, so through here I'll be gone. But I think we are going to go on a slow grind higher. What is also interesting, of course, if you would do dollars again, it would even be better. But is that you don't have to pay any funding to be long Euro Swiss. You actually get a little bit of positive carry if you're long Euro Swiss. So that is actually not too bad. So I think we could go up to somewhere around 97.5. I'm not looking for parity or either, but let's see where this thing takes us. Right, let's straight away go and have a look at that sterling CAD. You will see it's a very empty chart. No, I'm even having lines on there. Lovely. Derigi 165. 70, 80, 65, 80 is where it should cap in that zone. For as long as we're below there, it does look good for a move back down. But I think, of course, because you're playing one of the weaker currencies now, sterling really getting hit, and one of the stronger currencies, and they're both it's supported by the fundamentals right now with higher oil, better Canadian data, or stronger inflation. And actually, they weren't too bad on the retail sales as well. So better Canadian data and a lot of data about the strength of the sterling. So this is across where I think for as long as we are below that level here, we have there is a possibility of going to have a visit, perhaps why not into the 162s, and if really the proverbial crap hits the fan, I'm going to stay correct with my wording. Even why not into the 160s, okay? But keep a close eye on that one.
Let us know what you're doing, Durej, as well, because
sorry?
I'm just saying, just let us know what you're thinking as well, Durej, because just asking us for a pair, we can give our opinion, but we want to know what you're looking at as well.
Absolutely. And then, as I said in the room as well, keep an eye on what's happening here today on this dollar Swiss, 90.85, 91 the figure. We are pushing against the 91 the figure, so keep an eye on that one for probably the further development of the dollar Swiss, perhaps even throughout the week. But as Ryan already showed us, we do have pretty important US data as well. Being at the close of this quarter and at the close of the month, we have seen interest rates. If you look at the dollar interest rates, they are really, really, really pushing on. We should be monitoring 455, 463, that zone here on the US 10s. It is so that fixed income is getting a bit hammered. The equities are getting hammered again. So being in the last week and seeing what is going on, there is this possibility, and I think it's actually a pretty decent possibility that we see a final question mark rush into the dollar this week. We have to be really careful, especially towards the end of the week, what's going on with the dollar. Okay, and it could be a temporary final or a final rush into the dollar or so, but that are the data are going to tell us. The consumer data, as Ryan already mentioned, are going to be important. But it does seem to me that there could be this final rush into the dollar for the end of the week. So be a bit careful when you counter trade stuff. And that final rush, it doesn't show too much in the euro. And then you look at the euro dollar. That one is a bit slow as well compared to others, such as cable or yen or Swissy. The euro is holding up relatively well through certain crosses. The Canadian being an exception because that's supported with decent data. So I was mentioning that in the room as well last week. We are on those levels here in the EuroCAD. Seeing a small rebound from the Friday lows. I've highlighted this zone here between 143 and a quarter and 142.80. I think that's a pretty important zone to start the week on the EuroCAD. It's trying to hold this level. So keep an eye on where we close the Monday here, perhaps above or below 143.30. And if you would get lower here, you have another level to pay close attention to, which is going to be 142.30.40. If that goes, then that really means that the market is built up on the Canadian dollar, and we could really see levels back down. Why not into the 140s? But one step at a time, I'm going to say in this one, because we already did a decent move here. So, and looking at how the euro behaves right now, it's still low. It is low, but it's doing not too bad on some crosses. Aussie and Kiwi still being in the Canadian camp. On the dollar CAD, I'm not going to say too much because I think some say like this level is important here. Well, we knew it was a relatively important, this 134.70 figure, but it looks a bit heavy still. We may have a look at 134. 25.30 before reassessing. Okay. Euro, quick one to start the week. We still have not broken those levels. We're still holding just above 106.10.15. We tagged it on when was it that we tagged it? On Thursday. We tagged it, but we are still holding. So, and if something holds, just respect it and respect that level for now. For those who have longer term positions, I think we have to get above 106.90 figure to start to reverse a little bit, but the real reverse will not happen before 107.75, 108. If anything on the euro dollar, which is a bit away. for as long as that doesn't break anymore. It's still overall globally bearish, but again, we could just be flatlining here for a while and then let the month-end, quarter-end flows do. If we get a real dump into month-end or quarter-end, I am starting to just think about it. I'm not going to buy it right now. It doesn't. It's no use for me. But just starting to think about it. If we see levels deep into the 105s, 104s, I'm just going to monitor where we end the week. Now then, well, dollar yen. You already showed the dollar yen, did you?
Yeah.
Okay.
Yeah.
Anything else that we watch at just to close today? Look at those. Well, yeah, I mean, all the yen crosses are still bid, right? And especially the commod yens. So we are around 88.60 on the Kiwi yen. Keep an eye on what's going to happen anywhere between 89.20 and 89.60 if we start to test up there. And again, we've been saying it earlier in the show. I do think that the MOF and friends are looking at the trade weighted index there, and we should not only be looking at the speed of things, but also levels where they are, and we are at higher levels again on commodity currencies versus the yen. Euro yen is also holding very well. It's a bit of a range and a box here on the euro yen, but it keeps bouncing off those levels. Okay, so that still means that the yen is under the cosh, which is, in my opinion, logic because the Bank of Japan is not giving us much. So yeah, that's a bit logic to me. Quick look on the metals to start the week. Still doing pretty well, those metals. We are hanging around those moving averages on silver. I would not exclude, if I'm right on that final dollar rush or so for the next few days, depending on the data, of course. If I'm right on that, I would not exclude a move back to high 22s or so on silver. But if we get down there, I'm going to look at putting some on again. Well, adding to what I have at least. Gold as well. Not a lot to say around here. We tried above, then we capped, and that's in the 35 zone on gold. That's my level to watch on the top side. 19 the figure down to 1885 on the downside. It looks a little bit similar, or it feels a little bit similar as silver. If we get a decent move lower here into the end of the month, that could provide an opportunity perhaps. And I finish just with the one why sterling is weak. Those differentials with the US, they are capping the cable right now. We really should keep an eye on those ones. If they stick around low, those lows here, or even push deeper down, cable is going to suffer more. For the time being, they are stabilizing, and look at what the cable is doing. It's stabilizing as well. So I'm just following those things pretty closely to see what I'm doing with the cable. And that's it for me, Ryan. Back over to you.
Thank you very much, mate. And yeah, good luck with your pound CAD short, Derij. I hope you make many pips out of it. Well, thank you very much for coming to the Flow Show. Nice little starter for the week. Lots to trade this week, I assume. So stay safe, trade well, and we shall catch up with you tomorrow morning. Cheers, Kate. Thanks all.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.